All right. So where did we stop last week? Every Thursday we have our intermediate session. Today is Monday, so it's actually for absolute beginners. So if you were not here last week and you watched the video on YouTube, you are supposed to know where we stopped. So can someone just remind me, where did we stop? Market structure is actually for the intermediates. Market structure is for the intermediates. So where did we stop last week? For beginners. So if you know it, you can just tell me. Okay, nobody remember. But I believe you guys watched the video on YouTube, right? If you watched the video, let me know. Okay. So why you not gonna know where we first stop? Okay, Abraham said not yet. So Mr. Abraham, it will be advisable for you to go and watch that one because that was where we started from. We talked about some basic things, that are very important as well. So it will be advisable to watch that video. So I'll drop the link to that one maybe after this class, or should I just drop it now so that I won't forget? Let me try and drop it now, then we start. Okay. And if you are not on my YouTube channel, you are missing out. There are some videos there that can still help you as a beginner. Can still help you. Yes, I think this is the video. Sure. Okay, I just dropped it on the community. So that's it. Go and watch that one. After this class, you go and watch that one. You will learn some certain things there. But I believe where we stopped was on where did we stop? Okay, wait. Let me check where we stopped. So I can maybe I'll start. I believe we stopped at a bid and ask price. We stopped at bid and ask price. Yes. We stopped at the bid and ask price. Right? If that's it, just tell me, let me know. I think that was where we stopped. So I'll start from there today. So, but basically, let me just do a recap so that Mr. Abraham can still get some certain insights before you watch the video. Now, what we talked about last week was that the full meaning of the word forex trading is actually foreign exchange. Forex stands for foreign exchange, and foreign exchange has to do with the exchange of foreign currencies. Yes, let's say, take for example, you want to go and change your dollar to naira. That's foreign exchange. So that's the same way it works here. What we do is that we buy one currency against another. That's why you see GBP, JPY here. We also have a lot of different currency pairs. Let me show you. We have a lot of currency pairs. This is Euro USD. This is USD JPY. USD stands for United States dollars. So JPY stands for Japanese yen. So how they basically do this is that they collect the first two letters of the country and the first letter of the currency. That's where you get this theory. So GBP stands for Great British pounds. Then JP stands for Japanese, Y stands for yen. If you have NGN, NG stands for Nigeria, the N stands for Naira. So that's how it basically works. So if you see GBP JPY, it's talking about Japanese Great British pounds against the Japanese yen. So that's what we have here as our chart. This particular candlestick you are seeing here is a representative of these particular currency pairs. So the red one here stands for this JPY. The blue one stands for this GBP. So what we talked about last was that whenever you are buying the market, you are actually saying that the market is going to be bullish, and that means GBP is going to gain the strength. And whenever you are selling, you are actually saying the market will be bearish, which means JPY is going to gain the strength. Do you understand? If you are getting me, you can drop it on the community. Drop your answers in the community so that I'll know if you're understanding me or if I basically need to go over it again. Okay, you can understand. Okay. So let me go back to the chart. You can see my chart, right? All right. So that's basically what we talked about, and we said these two currencies you see here, the first one is the base currency, the second one is the quote currency. Now if you have Euro USD, your base currency is Euro, your quote currency is USD. What I'm simply saying is that whenever you have a currency pair like this, the first one among the two is actually your base currency, while the second one is your quote currency. And when you are trading forex, you are actually buying or selling your base currency. So it is the subject of your transaction. And I believe I give an explanation using maybe your normal market. Let's say you have 100,000 naira and you want to buy a shoe. At the same time, you want to buy some clothes. So if you go to the market, you only need to carry that money. You don't need anything else. With that money, you can buy shoe from inside and buy other things. Do you understand? So with only money, you can buy many things. So every other thing you are buying is your quotes. The money is the base because it's the subject of the transaction. You can use money to get shoe, you can use money to get house, you can use money to get car. So the money is the base. Do you understand? So picture GBP JPY, picture GBP as the base. The major thing you are looking at. Now that does not mean your quote currency is not important. Your quote currency tells you how many units of the base currency you need in order to trade foreign exchange market. Don't worry, when we get to lot size, I will explain that better. So let's see. Okay. I'm coming. I'm looking for our textbook. Alright, so that's it. Here it is, and we stopped at. We also talked about the three types of currency pairs. We have the major pairs, we have the minor pairs, and we have the exotic pairs. So when you go over that video, you will understand it better. So the major pairs are basically 7. We have US dollar is a major currency. We have euro is a major currency. We have JPY is a major currency. CAD, which stands for Canadian dollar, is a major currency. Swiss francs is a major currency, and AUD, Australian dollar, is also a major currency. Now, a major currency pair is when you are trading any of these seven currencies against the euro dollar. That's to say, let's say against dollar. Sorry, let's say you have Euro USD. That's a major currency pair because US dollar is major, Euro is major. So once you are trading Euro USD, you are trading a major currency pair. And what's the advantage of trading a major currency pair? The spreads are little. so they don't have a lot in a they don't have wider spreads, and the market is very volatile. So okay, okay. You see, these are the most actively traded currency pairs involving the US dollar against another major currency pair. You understand? So that's that's one of the advantage. Then the second one is the minor pair, is also known as crosses. These pairs are actually any of that seven major pair traded against each other, excluding US dollars. So if you have GBP, is a major pair. If you have a GBP JPY, like the one we have here, this is a minor pair, because GBP is a major. This is a minor currency pair because GBP is a major currency. JPY is a major currency. Together they are not minor currency because it's not being traded against the US dollar. You understand? It's not being traded against the US dollar. So if it were to be traded against the US dollar, it would be a major currency pair. You understand? Then the exotic pairs, when you have the currency of a small economy, like maybe Mexico pesos or whatever, any other money outside this seven, any other currency pair, any other currency outside this seven. So if you are trading them against any of these seven, it's called exotic pairs. And it's not advisable to trade it because they have wider spreads and they have wider spreads and low volatility. Sometimes the market can affect them for your disadvantage anyway. So you don't want to trade them, most especially as a beginner. Even me, I don't trade them. I don't even trade them. I only trade three currencies. I trade GBP JPY. I trade Euro USD and I trade CAD JPY. So these are my three major currencies my three main currencies I trade. So it's not advisable to go there at all. So we talked about spread, like what she just said here. Okay. Yeah. So I thought somebody dropped a message concerning. Okay, spread is the difference between. Oh, you asked a question. What is spread? Promise. Thank you very much. Thank you very much. I love this. So spread is the difference between the bid and ask price. So in case you don't know what bid and ask price is, watch the previous video. Let's start today's class. Everything that question you asked, they are there. So, and we stopped at that spread. So today I want us to talk about something else. What should we talk about? Today I want us to talk about lot size. No, before we get to lot, we'll talk about lot size today. But before we get to lot size, let's see something. Okay, we've already talked about the base and code currency. So if we're talking about the base and code currency, now I want you guys to know the participants in the industry. That has to say, who are the people that trade the forex market? Who are the people that trade forex? When you hear forex trading, who are the people that trade it? Now, there are two main participants in forex trading. There are two main participants in the industry, guys. There are two sets of people that trade foreign exchange market. This applies to all general markets. You know, in our last video, I talked about, I told you guys that there are a lot of financial markets. We have crypto, we have stock, we have forex, we have futures, and all of them. Now, every market has what we call the waves, but in forex trading, I'm going to be looking at forex trading. So now there are two main participants in the foreign exchange market. We have the institutions. Please don't forget this because it will help you in the future of your forex journey. So we have the institutions. Who are the institutions? Yeah, right. They are also known as the whales. You are supposed to know what whales represent in the sea. So they are also known as the whales. They are the market makers. These people are the ones who decide where the market go. You understand? Now, These institutions can be the banks, super banks, large commercial companies, government and central banks. So it has to do with big people, big men, odogus them. So now the other set of persons are the retail traders. That's you and me who are just coming in, you understand? So we are the retail traders. Now these retail traders are people that trade with small money, the obedient ones, the ones that follows the rules. So that's it. So now, so retail traders are those that trade with smaller capitals, comparing to what forex requires. You understand? So now, let's talk about lot size. In forex trading, a lot size represents the number of base currency units you are trading in a single transaction. Understanding lot size is crucial because they directly impact the amount of money you risk and potentially profit from each trade. Okay, here's a comprehensive breakdown. So what I'm trying to say here is that lot size, one of the reason why you must pay attention to this part is because if you miss it, you will just be losing your money. Like you'll be losing your money to be regular, to be normal. You understand? So if you don't want to lose your money regularly, you want to understand how to calculate your risk. You want to decide how much you are able to risk per trade. Then I think you should listen to this aspect of this teaching. I think you should listen to it. Very essential. Very essential. So this is the mathematics in forex trading. Let's use that word. This is the mathematics in forex trading. So now, he said in forex trading, lot size represent the number of base currency. Note the number of base currency. Guys, I told you that this is the base and this is the quote. So what he's saying is that lot size represents the number of this guy, the GBP JPY, the GBP you need in order to trade this particular pair. Now, if you are trading Euro USD, it will represent the number of euro you need in order to trade that particular pair. So it always represents the number of the base currency. You understand? It always represents the number of this base currency. Now, there are different types of lot size. We have four main types of lot size. We have standard lot size. Now, from the word standard, you are supposed to know what it means. If somebody tells you you are not my standard, it actually means you are not equal to that person. You are not in that person's level. You understand? So, guys, if you can hear me and if you're understanding what I'm saying, I would like your reactions. Just always comment your reactions on the group so I will know if you're understanding. Correct. It helps me so that I'm talking to you. Okay, so now as I was saying, standard lot size, it represents the very word standard. You are not my standard now, so it means you are not equal to me. That person is higher than you. So when we say standard lot size, we're actually talking about the exact amount you need as a trader before you can become a forex trader. That's what we are just talking about. So the actual money you can use to trade forex. Then we will later get to why you can trade with your $10, why you can trade with your $100. We will get to all those things, but I want you to know that standard lot size represents the standard amount of this base currency. That is this GBP here. You know we are using GBP JPY. This GBP here, the standard amount of this GBP you need before you can trade. And let's see. It is called a standard lot size because it carries the actual amount of money needed to trade the foreign exchange markets. You understand? Now, this is why you are not the whales. This is why you are not the market mover. Yes, the fixed value. I love that word. It's not the market. This is why you are not the market maker, because you don't have this kind of money. You don't have it. So let me show you now, so you know you don't have it. So standard lot size. The size of a standard lot size is 100,000 units of your base currency. 100,000 units. Do you understand? 100. So if you are trading GBP JPY, you need 100,000 Great British pounds. You have 100,000 British pounds and you want to trade. Why are you trading? So you need, for you to be able to trade forex, you need 100,000 GBP. 100,000. If you are trading USD JPY, that is United States dollars against Japanese yen, you need 100,000 US dollars. So you can understand now here. You understand? So if you are trading Euro USD, you need 100,000 euro. Where you take it down? So wow, yes, that's it. Wow, it's really, really wow. Now this is why you are not the big whale. Understand? So now the impact of a standard lot size is that trading standard lot size requires significant capital and carries substantial risk, and small peak movement can result in a large profit or loss. This is generally unsuitable for beginners. So what I'm saying here is that if you are using a standard lot size, for every movement, we'll get to Pip very soon. For every Pip movement, you are making or losing something big. You understand? Let me give you an example. Let me do something here. Let's take, for example, you are in this trade from here. Maybe you have done your analysis and the thing is telling you to buy. It's telling you to buy, and you are buying from here, fixing your stop loss maybe here. So this is a very good risk to reward ratio. Let's say you are targeting this point. This is a very good C3. Okay, it's also good. So now if you are risking this place where my cost rate is your stop loss, you are supposed to know that already. Now if you are risking maybe $1,000 a year, you are going to be making $3,600 from this trade. That's why you have 3.6. You understand? That's if you are risking $1,000. Now, do you know that it's possible for me and you to take this trade, this same target, this exact target, and I'll be making maybe that $3,600, but you'll be making $36. The same target, and he hit our TP, but me, I'm leaving the trade with $3,600, but you are leaving with your $36. Now, what causes that is lot size. You understand? Lot size. That's what determines how much you make and how much you risk. Note, me that is making $3,600. If the trade goes against us, I'll be losing $1,000. If the trade goes against you, you'll be losing $10. You understand? So now, for me to be losing that $1,000 here, we need to calculate pips and all that. But basically now we're talking about the lot size. So it means maybe I'm using a standard lot size, but you are not using a standard lot size. That's why. You understand? So as small as this movement, you will see, if you go online and you will see big traders like Jeffrey Bensi, Abi Forex, and all those our top traders in Nigeria. Now you will see them, they will show you this kind of chart, this small thing here, and you'll be seeing that they'll be showing you that, all right guys, this $100, I made $100,000 from this trade. If you use this small movement from year to year, $100,000 from year to year. So you understand? And so that impact is as a result of lot size. Yesterday I was watching one of Jeff Bensi's video. He was talking about a trade he took. He used 100 lot size. That's 100 standard lot size. See, for every people movement, don't worry, we'll get to pip. For every people movement, you make $10 per pip. For when you are using a standard lot size, you make $10 per pip. Now imagine you are using one standard lot size. Imagine you are now using 100 standard lot size. So you are, for one pip movement, you are making $10 times 100. Let me calculate it. I did this in my class. I'm in class. Yes, I did. Okay, $10 times 100. Okay, that's $1,000. For every pip movement, he's making $1,000. You understand? So you just need 100 pips, 100 pips, 100 pips to make 100K dollars. You just need 100 pips. You understand? To get $100,000. Wow. Guys, let me tell you one thing about forex trading and about life. If you want to succeed, honor people that have made it. You understand? It's very important. So let's go back to what we are saying. All right, so that's the impact of standard lot. But imagine the trade is going against you. So it impacts your profit. It also impacts your losses. So that one is not advisable for beginners like you. It's not. You don't want to use that one now. Even me, I don't use that one now. I don't even have that kind of money for now. So the next one we have here after the standard lot size is the mini lot size. Now, the size of the mini lot size is that you need 10,000 units of this base currency to trade a mini lot size. You need 10,000 units of this GBP here to trade a standard mini lot size. You understand? Now, the impact is that mini lot size reduces risk and capital requirement compared to standard lot size. Yes, compared to standard lot size. So they are more accessible to beginners and those with smaller trading accounts. If you have now, when we say smaller trading accounts, there is this kind of smaller trading account we are still talking about. Maybe you have $100. Yeah, you can still use mini lot size if you have $100. Yeah, but you don't want to try it if you have $10. You know now. Unless you want to risk that $10 just on one trade. That is right here now your $10 and you're expecting $30. You understand? So but if you want to manage risk, you don't want to use $10. You don't want to use mini lot size because you know for your standard lot size, every peak movement is worth $10. Now for your mini lot size, every peak movement will be $1. Sorry, $1, not $1. Will be $1. You understand? So that's it. That's why I told you I can be making $3,600 and you'll be making $36. Maybe you use mini lot size and me I use standard lot size. So that's it. Then the next one here is the macro lot size. It's more smaller. You need 1,000 units of the base currency to trade macro lot size. You need 1,000 units of the base currency. You understand? Now the impact is that macro lots are the smallest, whatever. Just reduce it for every pip movement. You are making or losing, I think 10 cents. You are making. Guys, can you hear me? Are you understanding what I'm saying? I need your response. I need your response. Okay. All right. Now, for every pip movement, you are either making or losing 10 cents. So 10 cents is not even up to $1. You understand? So that's the impact of that one. And the thing is, if the trade goes for you, still making it by cent, very small money. All right. Okay. All right. So the last one here, you see this last one. I just added it to this place, to this textbook for adding sake. For adding sake, it's not as if you will trade it. You won't. It's called nano lot size. Nano lot size is the smallest of all lot size. You understand? The impact is that sorry, before I talk about the impact, let me talk about the size. It actually is I think 100. Okay, you need 100 units of your base currency to trade it. Remember the standard lot size, you need 100,000. But this nano lot size, you just need only 100, not 1,000, just 100. You understand? And this is it. For every pip movement, you are making 1 cent. So you need to target 100 pips. Okay. Let me see this question. sir, what would happen if the market goes against us when this standard lot will be going there? Okay, let's pause. I'll get here very soon. I'll get here very soon, guys. We are still coming. I'll answer your questions. But let me quickly say what I want to say before I forget. So now what which I need to understand. Okay, you need 100 GBP to trade in nano. Now, for you to make $1 using nano lot size, you need to target 100 pips, and you know that 100 pips can be your daily target. If you can be making, see, if there's a way you can just be making 100 pips every day, and you are sure you are not going to be losing, you are the best. Yes, there are professionals. There are people that can target 1,000, 2,000 pips per trade. Those swing traders. But if you can target 100 pips in a day, you are good. If you can catch this kind of movement in a day, you are good. So that's it. So that's the impact of lot size. Now, the main thing you need to know about lot size is that so how to calculate a lot size. But before we enter how to calculate lot size, you need to understand what is PIP. No sound. Can you hear me now? I believe it's your network. Okay, you can hear me now. All right. So now, how do we calculate lot size? Oh, before we get there, let's talk about pips. But let me quickly answer this. Should I answer this question now? Oh, no. See, most of the questions you are asking here, the reason why I won't answer it now is because we are not there yet in our teachings. You understand? So I want us to climb it step by step. But I love the way you are asking the questions. Let's just keep the questions. You understand? So in the course of this class, you will learn it. Even if you don't learn them today, you will learn it definitely. So let's keep the questions. All right. You can write this somewhere in your book so that if we are talking about it and I fail to hit the nail on the head, you just remind me. Okay. So now let's talk about PIP. What is PIP? We've talked about spread, and I said spread is the difference between your bid and your ask, and I told you what bid is and what ask is. So if you are selling for $100 and I'm buying for $90, the $10 is the spread. If you still don't understand, watch the previous video, you understand it better. So now let's talk about PIP. Now in forex, PIP stands for calculating profit, losses, and position sizing. If you can't hear me, I believe it's network. Can you hear me now? You can hear me now. It's your network. It's network. Okay. All right. And you guys can see me, right? You can see my screen, right? Okay, I'll come again. But you can see my screen, Abi. Okay, all right. So now what I said is that so we are talking about pips, and I said in forex trading, pip stands for point in percentage. It's the smallest price movement a currency pair can make. Understanding pips is crucial for calculating profits, losses, and position sizing. Now, what is the importance of PIP? It is crucial for calculating what? For calculating your loss, your profit, and your position sizing. Do you understand? So before you can actually manipulate lot size, you need to understand PIP. You need to understand PIP. Now, what a PIP represents? A PIP in most currency pairs, I will show us. A PIP represents the fourth decimal place. For example, if euro is okay. Now, guys, I believe you guys have this note I'm reading. Hope you guys have it because I sent it to our WhatsApp group. So in case you don't have it, it's on the WhatsApp group. Now, you see these numbers here? Guys, I need your response. Okay. Okay, now let's talk about JPY. Now, PIP in when we talk about PIP, or let's talk about Euro USD first. Let's use the Euro dollar because it's kind of different. Okay, let's use this currency. Now, when we talk about PIP, if you see these particular numbers here, we have 1.16400, 1.16200, 1.16000, 1.15800. So all these things that they are the price market. Now, if you see this 1.15687, that's where the price currently is right now. You understand? That's where the price currently is right now. Now, if you are buying this market, the moment it's going up, the moment this price is decreasing, your money is increasing as well. Now, if you are selling and the price is increasing, your money is increasing.
Sir, no sound. I can't hear you.
You can hear me now, you say yes. Can you hear me now? Oh, okay. So if you can't hear me, you still watch the video on YouTube. I'll drop it on YouTube. So as we're saying, where was it? So this is the price and these are guys. So now, all right, thank you, Jesus. I said picture pip movement like steps, like you are walking. Now, take for example, you want to go somewhere, maybe you want to go to your neighbor's house, and you are like, I want make I use like 10 steps to reach there. You will have to calculate the distance between your first step and the other one, so that at the end it will be that 10 that you will use to get to your neighbor's house. You understand? So that's the same. Pip is actually the way price moves, just like you use step to move. The price, the market uses pip to move. So just when you hear pips, just think of it like footsteps, but that's the market way of moving. That's how me I picture it. I picture pips as the market way of walking, like walking, walking, like the market way of moving from one place to another. You understand? You have to know how to calculate the way the market moves. That's when we say calculate the pips, calculate the whatever. You understand? So now, here, right here, the pip of this particular price. Let me check it again. Let me check my notes again. Okay, pip. Okay. All right. In most currencies, a pip is typically the fourth decimal point, the fourth decimal place. You understand? For example, you have euro dollar, which is euro USD, moves from 1.1000 to 1.1001. This is it. Maybe 1.16. Okay, let's use the current price. 1.15685 to 1.15686. That's one pip movement. You understand? Do you understand? It's not hard. Just one. You can see the number here is even fluctuating from 89. You can enter 90 or you go back to 88. This is one pip downwards from 89 came down to 88. That's one pip downwards. So you took one pip, one step back. Now it's not 86. That's 3 step back. You understand? So just imagine it like that. Okay, look at now this black one here. We have 71. From 71 to 96. That's pip movement. You understand? That's how pip work. So now, basically understand that your pip is the fourth decimal number, or rather the fourth decimal place. Yeah, you understand? So we have 1, 2, 3, 4. Wait, this thing is not correct. Okay, now in this case, the last one, you just know that this last one is your pip. This one is pipette. Just as you have 60 seconds make 1 minute, 10 pipette makes 1 pip. You understand? So see, this thing has to do with decimal number. If you are good in maths, you understand decimal number now. Before you have this 1 here, this 0 have to count from 1 to 9, then go back to 0 for this one to come to 1. You understand? That's how it moves down to this point. You understand? So that's basically what I'm talking about. So this particular this 0 here, this last number here, is your pip. So now if you have, this is 1.16200. If you now have 1.16201, that's 1 pip movement. You understand? Now if you now have 1.16199, it's also 1 pip movement to the downside. I believe you guys are understanding what I'm saying. If you understand it, just comment so I know. Are you understanding me? Okay, let me come back again for Iriome. So what I'm saying is that this last decimal number here is your Pip. This last decimal number is your Pip. So for you to have a Pip movement, either to the up or to the down, let's use the up now. This 1.16000 will become 1.16001. If it becomes, okay, you see this black one, 022. Let me turn. Now 027, that's 5 pips. 2, 3, 4, 5, 6, 7. That's 5 pips. You understand? 5 pips from 22 to 27. From 27 now to this is also 5 pips. 7, 8, 9, 10, 11, 12. So that this is also 5 pips. You understand? Do you understand now? Okay. Eugene, do you understand? I need you guys to understand. Okay. Okay, you still don't understand. Now, let me explain again. You see this, but you can see these numbers here now, these particular numbers here. They are the price of the market. They are the price of the market. So currently now, this particular place where you have this blue one, you have this timing, this time counting under. This is where the price of this market currently is now. So now this Euro USD is currently no. I'll answer your question. Let me first of all make this guy understand. So now this 1.5736 is the current price. You can see you just entered 37. That's 1 pip movement. You understand? From 37 that 41 now. That's 37, 8, 9, 10, 11. That's 4 pip movement. It just come down to 25. So that's how the market, that's how the price moves. Sometimes it goes up, it comes down, it goes up, it comes down. That's how it moves. So now, let's use this particular number. You already know these are the prices. So this 1.15200, if it moves from 200 to 1.15201, that's 1 pip movement. You understand? So if it now goes down to 1.15199, that's also 1 pip movement to the down. So you can say Euro USD just dropped 1 pip movement to the downside. If it's going up, you can say Euro USD just pump 1 pip movement to the upside. So you understand now, right? Eugene, do you understand now? Okay, I think we should continue. So now, concerning your question, sir, what if the whole number goes up? Is it still 1 pip? No, it's not. So what you have to do is to learn how to calculate it. From this particular place now to here, you cannot call it 1 pip. You understand? So let me even see. This is 200 here. If we have 300, that's already 100 pips. If we have 400, that's 200 pips. From here to here, this here, so to here, may you see, is 200 pip movement. 200 pips movement from this 15200 to this 15400. Do you understand? So that's how it works. Now let's go to JPY, because JPY zone is little different. So I don't think we'll do how to calculate it today, because we are already out of time. So next week, that's when we'll do how to calculate lot size. But today, let's just complete this people talk. GBP, JPY. Let's see this one. This, you see this trade now. Imagine you are using one standard lot here. This, you see it, you have lost your $10,000. So that's it. But imagine it was going fine. Block, block. In case you guys don't know Mrs. Happiness, I dropped a link on our group. She goes live every Tuesday. Every Tuesday night, like tonight she'll be live, and I believe you guys should join the live, even if you are not trading. Just observe how she's doing it. You understand? So I will drop the link to our YouTube channel on our group. You can still watch some of our videos. It will still help you. I know go live for you. I learned a lot from her. So it's better. It will still be good for you. It will still be good for you. As you are learning from here, you just be using our. I want to refresh your mind as well. So now let's talk about this JPY. Now you can see that this price here is kind of different from the JP1. We have our point after three numbers, you understand? But it's almost the same thing though. Now for the JPY pairs, the pip is the second decimal place because the yen is typically weaker against other currencies. So this JPY is weaker against every other currency. So for the JPY pair, the pip is the second decimal place. You understand? Guys, I'm coming. Guys, can you guys hear me? Can you hear me? I need to correct something ASAP. I need to correct something now, like right now. I just need to make it. Yes, no, it means. Okay. This one no come here. No here, no. See this trade. See. This one is 34.72 risk to the world. So if you are risking $100 here, you make $3,400. I believe so. Okay. So now I need to correct something. You see this last number here? That's not the pip. Look at the pip here. This second zero. You understand? That's not the, everything I've explained since is the same, but this is the pip, not the second zero, not this last one. This particular one is that book that confused me. I'm very sorry for that. So this particular one here is the pip, not this one. You understand? If you understand it, just write yes so that I will explain better. So what it means is that this 1.16200 here, this one is the pip before this last one. So if we have 1.16210, that's where you have what? One pip. Do you understand? I'm going to get this thing right. Let me just check it again. Okay. Let me check it. I'm coming. Let me check it. Um, explain Pip for me. Anything that you're programming in forex. Pip stands for percentage in points or points per second or price interest points. It is the smallest standard unit of price movement in the currency. How it works. 1 pip 0.00. Okay, I'm coming, guys. Okay. Yeah. So as I was saying, you see this last one here. This is pipette. Then this one is the pip. Even when I was telling you guys that first time, I was trying to. I'll go and write this book. I was trying to think about it because I know that if you call this one pip, yes, for year to year, this 20 pip, you are trading, you are risking 20 pip. So guys, let me explain it again. Now, this 1.16200, the last zero here is your pipette. So if you have 1.16201, that's you have one pipette move, just one pipette. Then if you have 1.16210, that is 210, that's one pip. You understand? So pip is this second number here. Do you understand? Okay, Dr. Irene, do you understand now? Pip is this second number here. The same thing I've been explaining, but it's just the positioning that you guys need to know about now. What about Abraham? Do you understand? Gideon. Anyway, so now I'm sorry for that. I'm really sorry. So this second number here, this second one, is your pip. So how do you know your pip? After your point, the fourth decimal place. After the point, the fourth decimal place, that's 1, 2, 3, 4 is your pip. Then the next one, the fifth one, is your pipette. The fifth one is your pipette. You understand? This one is your pip. This fifth one is your pipette. Hope you guys understand now. Now, then the same thing, you cannot calculate it like that. So from this particular 1.6200 to this 1.16400 is 20 pips. You understand? Then 200 pipettes. But you remove the pipettes. You have 20 pips, right?
Yes,
Guys. Okay.
yes.
So you have 20 pips. Then from this 1001, this 1.16400 to 1.16600 is also 20 pips. So what you are seeing here is actually 20 pips distance. You understand? The pip is this particular one. You need to understand, not the first one I said. So let's move this thing. You don't say where I go. So Okay, that's why I just made that mistake just now. But we can go on now. It's rectified. Glory to God. So G B P J P Y. Let's use this one. Now right here, you can see we only have three decimal number here. Only three. We have 196.000, but for euro, dollar, and other pairs, we have 1 point whatever, 2 point whatever, any number point whatever. But here we have 196.2. So you can just take note of this particular after the point and the other part. That's where we are talking about. So your peak will now be the second one here. Do you understand? So for euro, dollar, and other currency pair, your peak is the fourth decimal number after the point. But right here, after the point, we have only three. So your pip is the second. This one is your pipette. You understand? Do you guys understand? Okay. Okay. So the same calculation goes. Yes, the same calculation goes with it. The same calculation goes with it. So from here, from this particular price where we have 000 to this place where we have 200, we have 200 pips. Sorry, 200 pipettes, and we have 20 pips. You understand? 200 pipettes, 20 pips. So that is it. It's very simple. It's very simple. It's very simple. So this one is the pip. This one is the pipette. You understand? This one is the pip. This one is the pipette. So the pipette, just one general thing you should know about the both sides. Now this one is for any currency pair that has this JPY. That's where you see this thing like this. But for the rest without JPY, you see it as if we saw it in the Euro USD. That's how you see it. You understand? Then any other one that does not have, that has JPY, we will see it like this. But the thing is, the pip is always before the last number. Before the last number, that's where you have your pip. It's always there before the last number. You have your pip before the last number. So that's basically it. The next week class, we'll talk about how to calculate pip. We'll talk about how to calculate pips so that you will know the actual lot size that matches every of your trades. So we'll talk about risk management as well next week. So you don't want to miss it. So that's where you know that you are the one that decide how much you want to risk. We also do some other subjects and other topics that are not physically, they are not something you will have to do physically in your chart. It's called trading psychology. That's why you don't have to now be analyzing trading psychology. No. Trading psychology is about you knowing about you, how your personality affects your trading. You now discover that trading is 20% your technical analysis, 80% your skill. Sorry, not your skill. 80% your psychology. So you must train your psychology as well as you are training your technicality, your technical analysis. So let me just quickly do a recap because I spent time explaining that this place has PIP. So let me quickly use this pair to explain PIP better for like 3 minutes before we round up. You have a question? Okay. So now what I'm saying about PIP is that generally for currency pair, the second number before the last one, the second to last number is your pip. You understand? Is your pip. Now, from this particular place, you can see it's 20 pips. It's 20 pips. It's 20 pips. You understand? So that's basically what you need to know about pip. So right now we have this number, this black number as 1F. Let me know it's 500. 1F4, 1F5.495. So if you move from 1F5.495 to 1F5.505, that's 1 pip. You understand? This is 1 pip. This is 1 pip. From here to here. So basically 10 pipettes makes 1 pip. You know, I told us earlier that 10 pipettes makes 1 pip, but the calculation was wrong that time. So if you have 10 of this one, it gives you 1 pip. What did I even the talk say? So you know, if you are counting your number from your decimal, you need to have this one to be 10 before this one will be 1. I hope you know decimal number. I'm not supposed to know decimal number and this thing for mass. Although me, I don't forget to. So if you have this one to be 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, then you go back to 0. This one becomes 1. You understand? Then this one now, this one will have to repeat that thing many times for this one to become 9. Then when this one I repeat it again, this one will go back to 0. This one becomes 1. That is how it counts. So that's why 10 pipettes makes 1 pip. You understand? So you need to have 10 of this one to get 1 of this one. Do you guys understand? If you understand, just say yes, I understand, so that we can round up. Okay. So basically that's how it works. I'm really sorry for that first error. I'm really sorry. So thank God we were able to rectify it, because when I was saying it, I was like, no, this thing is not correct too. How can you say the last one, the pipette, the second to the last one? No, it's 10 pipettes that makes 1 pip. But okay, you want to speak? Okay. So yeah, you can say what you want to say, Dr. Irene.
I don't want to
All
say
right, now any question? Okay, I thought you wanted to say something. If you have any question, you can ask for, like, let's just do that one for
boss.
Yeah.
How come 10 pipettes make 1 pip?
I've been explaining it since now. See it. This number here is your pipette. This one is your pip. So you need this one to count 1 to 10 for you to get this one. Just okay. See it like this. See it like you are counting 1, 2, 3. If you count 1, 2, 3, 4, 5, 6, 7, 8, 9, then what happens? You have 10. 10 is a combination of two numbers, 1 and 0. What happened is that one that was counting 1, 2, 3, 4, 5, 6, 7, 8, 9 went back to 0. Then all of them together gave this other one the value of 1. You understand?
Yes, I understand. That is it.
This is what you will do. I think it will be better. Just go on YouTube, search for understanding decimal numbers. Very simple. How decimal numbers are being counted. That's 1, 2, 3. That one maybe they see. That one that you think you have. That one that you use to start 1, 2, 3. There are a lot of things now they come together to bring 1. That's why you have 1 million. 1 million carries 6 zeros. Now for you to have 2 million, those 6 zeros, this one have to become 1, 2, 3, 4, 5, 7, 9, 10. So we now work that like that to this point before it becomes 2 million. Have 2 0. Do you understand? So that's how it works.
Yeah,
So if
I
you is there any
understand.
other question? All
No,
right.
no.
Any other question? If you don't have any question, just write no question. If you have any question, ask. If you don't have anyone, just write no question so I'll know. No questions. No questions. I don't have any. Okay. 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 That's to say you guys understood what we did tonight, right? You understood that there was a little mistake, but we rectified it. You now understand how Pip and Pipet works. So I believe you guys understand it now. All right. Okay. No problem. So see you guys in our next class. But before I leave, I want to leave you guys with an assignment from everything we have done since last week. So submit this. I gave an assignment on Thursday. Okay, it's for Thursday class. For Thursday class, that's market structure. So submit this assignment before next class on Monday. Next beginner class, which is on Monday. Submit this assignment before then. Now, what's the assignment? I want you guys to tell me to calculate. No, not calculate. We haven't done calculation. Now, okay, I will drop the assignment on the group. I will type it on the group. I will type it on the group. See you guys later, or see you guys tomorrow. So there's this thing coming up right now. I'm trying to bring my signal room together. I'm trying to bring my signal room together. What's the advantage of that signal room? Is that as you are learning, you can be making money from other traders who already knows how to trade. So what it does is that they will analyze the market, they will drop, they will call the price for you, your entry price, your where you are supposed to leave the market, where you are supposed to put your risk. They will just do everything for you. Your own is to go to your MT5 and place it. If you don't know how to use MT5, there's a video on YouTube on that. So as you are learning, you can be making money. You can be making money from that. If you have like $20, you can fund your broker and start. If you have like $20, because OctaFS, that is my recommended broker. OctaFS, you can only start with $20. You can only start with $20 with OctaFS. So if you have $20, you can start. And if you are interested, DM me privately, maybe on WhatsApp or here on Telegram. Just message me direct for signals. Although it's a paid one, you will pay because I'm not the one who is going to be dropping signals there. I don't even have that chance. I'll be dropping, but not just me. We'll have like 5 traders so that you guys can be getting signals every day. Imagine the day I now see my setup, the other person will see their own, the other person will see their own. So every day, 2 or more signals will be going in on that room, and I'll have to pay those guys because they are not doing it for free. So that's why you have to pay. That's why you have to pay for the signal class, because multiple traders will be there. So, but if you're interested, you just DM me. Let's talk about that. Good night, guys. See you guys in the next class. All right.